Hey guys, Brian here. Hope your week's going great. All of the stock market's historical peaks were preceded by extended periods of calm, optimism, complacency. In this video, we'll look at some of those previous peaks. We'll look at some of the indicators of financial stress, and we'll see where they were then and where they are today. A lot of these stress indicators you probably haven't seen before, so stay with me. All right, guys, welcome back. No scenery today. I've been traveling a lot. The first graph I want to look at is the financial stress index. This one comes from St. Louis Fed. It's various interest rates, yield spreads, essentially a proxy for the amount of stress in the financial system. We have it inverted, so these big dips here are high stress levels, and these peaks here indicate low stress in the financial markets. At present, financial stress has nearly disappeared again, right? The latest reading is negative 0.93. That is the most complacent attitude since June 1, 2007. That was just 6 days after the peak in the S&P financials. The Dow, the S&P, the NASDAQ, all of those indexes peaked in October that year. And of course, a generational bear market got underway. Now, granted, there's a lot of points on this graph that showed low financial stress and the markets still moved higher, right? That's par for the course. We never want to use a single sentiment gauge by itself. We confirm these readings with Elliott Wave structure. We confirm them with other sentiment gauges. So take a look at this longer term perspective here. This is the AIM index back through the 1970s. So this one is compiled by sentimenttrader.com. It's a broader measure of market sentiment. We've got 50 different readings, 5 different sources. What is noteworthy on this chart here is the persistence of these extreme sentiment readings, right? The green line here, it's the 20-period moving average. And aside from one single week, it has stayed above 0.90 for the entirety of the first quarter 2024. It hit 0.93 actually on April 2nd, right? Highest reading in 53 years. Again, when these indicators are extreme, we want to be cautious with our positioning in the market. Now, I got 2 final graphs so we can see what's happening on a near-term basis. Middle graph here shows the exposure of the average active investment manager. So a reading of 100 here means the average manager is leveraged long, right? Basically anticipating higher equity prices. We hit 103, 104 and change during 2 weeks just this past March. Those were the most extreme readings since November 2021. That's an important date because that's when the Russell 2000 hit its all-time high. Same with the value line composite, same with the Dow transports. All of those indexes reversed from all-time highs late 2021. Now the bottom graph here also pretty remarkable because the exposure of the most bearish managers just flipped, right? Week of March 27, they flipped from fully negative, right, minus 200 to strongly positive, plus 50. That red arrow there, that shows we have to go back to November 2021 again to find a time where these managers were this positive on the market. So our view here, it is a big red warning sign when even the bears become bullish. The picture emerging is one of complacency, both long-term complacency and near-term. That's the story of this market, which is why we're being very careful about a significant turn here. Thanks for watching. I'll put subscription links in the comments if you want to subscribe to our newsletters, and see you in the next video.